YouTube, welcome back to the Investing on a 9 to 5 YouTube channel. If you're new here, I'm your host, the Dividend Dog, and tonight we're going to be diving into core four ETFs that I own in my investment portfolio. These ETFs are DGRO, SCHD, XLU, and SPLG. We'll discuss why I chose them, their key features, and basically how they fit into my long-term investment portfolio. So thank you guys for being here. Happy Tuesday. If you're new, once again, don't forget to like and subscribe to the channel so you don't miss out on any updated content. And thank you guys again for being here. So let's go ahead and get into the video. So an ETF basically is an exchange traded fund. Think of it as a basket of stocks that tracks your favorite grocery store, your favorite clothing, or your favorite just shoes in general. You know, like a sector just for shoes or a sector just for technology stocks where it tracks Apple, Microsoft, Google, all those things. Well, it puts it into one stock price, and therefore you can, buy one thing, and therefore it'll diversify your money throughout those companies. Now you're asking, or you may be asking, why are they important? Or this can be a refresher for all of our seasoned investors out there. Thank you guys for being here as well. It gives you broad market exposure, so it gives you exposure from all multiple points of the stock market. You can track a certain sector, and also it gets lower expense ratio, so you're not paying a lot of money to someone else to passively manage your money, such as you have to do with a mutual fund. ETFs comes out a little bit cheaper from the expense ratio standpoint. Now, let's first jump into our first ticker, DGRO, which stands for the iShares Core Dividend Growth ETF. This ETF focus on basically U.S. stocks that have a history of consistently growing their dividends. Why is it important, guys? Well, as you guys know, we preach on the channel, companies that regularly increase their dividends are more likely financially stable and have solid growth prospects within them, and then therefore, our money is therefore working better, and therefore that's how we win on the stock market here. So DJRO tracks the Morningstar U.S. Dividend Growth Index, guys, and it tracks companies like Microsoft, Johnson Johnson, Procter and Gamble. As you guys can see, the expense ratio is pretty low at 0.08, which is great for long-term investors like ourselves. I chose this one because it combines basically the stability of dividend-paying growth stocks with the potential for growth. So obviously, you guys can see from the last 5 years, it's at 76% return. Last year's got a 19% return. So it's basically almost performing in line with its category and almost in line with the S&P 500, which is not what we're looking to beat overall over time. It's just a good indicator and good metric to keep yourself in balance, long term as an investor. So this is what it would look like if you would have put $10,000 into this DGRO ticker in 2023 last summer, or basically around this time. You'd be upward a little bit over $12,000 right now. Now, as I mentioned in the previous slides, these are some of the tickers that are in this ETF. These are the top ones, the top drivers, which are really basically the most important companies in my eyes. And it can just, you take a quick glance at this and it'll let you know if this if the ETF's good for you or not. So you got XOM, Apple, Chevron, Microsoft, JPM, J&J or Johnson Johnson, Broadcom, Abbey, Procter & Gamble, Merco. So these, as you can see, they're all diverse into different sectors of the not the company, but of the stock market. And this is how much money they have invested into these companies through this ETF. And it shows you here, the weight and the percentage of the company. So when you basically go out and purchase a share of DGRO, your $56 will get ciphered out and funneled to not only these companies, but the other, 200 companies or whatever amount of companies that it's got in here. I can't think of it off the top of my head, but it'll get ciphered out through those. And therefore, your money is being low risk, but it's also companies that have a risk of growing their dividends and over the term. So as you guys can see here, I have currently 17 shares into our portfolio, me and my wife. So we have 17 shares, got a market value of a little bit over $1,000. And right now, total gain 0.95. Bought it in April 1st here. And, it's just been, stagnant. And the market's been going up and down here. We're really waiting on the NVIDIA earnings tomorrow. So hopefully we get some good earnings tomorrow from NVIDIA, which hopefully can help push the market and these ETFs here to the north side. As always, we focus on dividend growth here on the channel, whether it's an individual stock or an ETF. And this dividend ETF, DGRO, has been growing their dividend consistently, as you guys can see. Next up, we have SCHD, which is the Schwab US Dividend Equity ETF. Similar to DGRO, but this one here focuses on high quality US companies that pay dividends, but it has a slightly different approach. So it basically tracks the US Dividend 100 Index through the Dow Jones, which basically is sustainability and quality. The team over at Schwab, they have a great team with great metrics that go along with this ETF. So this was a little upgrade better than DGRO because the team at Schwab, they actually watched this ETF here. There's a company that comes through and it looks like they're about to cut their dividend or going through some financial troubles or not having a good balance sheet. They rebalance it and get that company out of there. So yeah, this is SCHD here. As you guys can see, I have a little bit right at 80 shares of the company of the ETF right now, up 9%, so up $552, priced out at $79.85 right now. And these are the companies here, or the sectors that this ETF will diversify you in. As you guys can see, one price, you get diversified into all these sectors. Therefore, you don't have to go purchase a company from each one of these. We're working on making the best dollar work for us, for the best bang for our buck. So these are the top companies here that included in SCHD. So you got PepsiCo, Verizon, Coca-Cola, Amagen, Texas Instruments, Chevron again, Pfizer, UPS. These are all solidified companies that, if the world were to stop again or we were to go back to COVID times and everyone's back in the house, these companies are more likely be used and have to, have a need in the world. Once again, these are companies that are safe dividends that are growing. The last 5 years, SCHD is 11%. Last 10 years, 10% here on the annualized returns. Once again, solid dividend growth here. Just to show you guys how important it is to reinvest the dividends, meaning that when you get paid a dividend from an ETF or a stock, you reinvest it back into the company. It helps boost your returns down the line. So just by reinvesting the dividends since 2011 is taking your returns from being 219% to 299%. So which is cool. Now, let's funnel over and talk about XLU, which is the utility sector. So basically, guys, this ETF here is all about stability and income, which focuses on the utilities. And you guys know utilities are known for being recession resistant, high inflation, because people need these services regardless of any type of economic conditions going on. Same thing with SCHD. Companies in there, people, we need these companies to work and have services no matter what's going on in the world. So we got XLU here priced out at $72. Right now I got 10 shares into it. Right now we're up 0.83%. So once again, like I said, guys, XLU, it tracks the utility sector, which includes like major players like NextEra Energy, which is mainly headquartered down in Florida. You got Southern here in Atlanta. You got Duke Energy, Constellation Energy, Sempra. You get the message. There's a lot of energy and utility companies, boring businesses, but these are the companies you want to buy in your long-term portfolio to create consistent income because these companies are needed and more likely, going to have stability and great balance sheets. Next up, we'll segue over and look once again, dividend growth is consistent. XLU's returns with reinvestment turns from 96% to 172%. So once again, consistent growing dividend growth in these ETFs is what you want to see. So last 5 years, XLU is up 44%, 21% the last 3 years. Year to date, it's up 15%. The last month, it's up 12%. So as you can see, it's in line or kind of, showing some respects to the S&P 500. And this is, once again, a boring ETF, but it's something that's needed to be owned in your long-term portfolios to help you withstand some, economic downturn in the market. Next, and finally, we have SPLG. And this is the SPDR portfolio S&P 500 ETF. Now, some of you guys may be like, well, why don't you just go buy VU? Yeah, I can go and buy VU, but buying VU, that's gonna what? That's $400, $500, 450 or so if you're talking that for one share of the S&P 500. Once again, trying to show the best bang for our buck here on how we can get into the game and still be able to make gains and get the same percentages off different ETFs. And I like having fun with this. So with the S&P 500, you guys know it holds the top holdings like Apple, Amazon, Facebook, Microsoft. These all represent the largest companies in the U.S. economy, the largest 500 companies in the U.S. economy. Expense ratio is extremely low at 0.003, making it an incredibly cost effective. Option for long term portfolio. Once again, guys, these are great long term ones. You guys can see I'm only starting out with 10 shares here, taking it day by day, week by week, month by month, whatever I can get into it. I will continue to add. And this one, like I said, this helps me diversify and gets me into, once again, all of these sectors here just by buying this $62 stock or ETF. And it gives me access to Apple. As you guys know, NVIDIA is running the market right now. We're waiting for their earnings tomorrow. Amazon, Meta, Google, both Googles, Berkshire Hathaway, shout out to Warren Buffett, Broadcom, Eli Lilly, who had a huge day today. So that, it spreads you out into the entire market with these just four funds here. If you're taking a look at it, and we got consistent dividend growth here with the S&P 500, but we're not really investing into the S&P 500 just to get, dividends out of it. I would say more so, me personally, not financial advice as always. I'm investing in this just to get the growth, therefore take profits down the line to go buy more heavily dividend income paying companies. So just to finish up, we'll do an ETF total here. So with SCHD, DGRO, XLU, and SPLG with the shares that I have, we have a total of $241 of dividend income yearly that I'm getting from these companies. So the more that I add, the higher this will go up. I would like to get this to $1,000 one day. So therefore, my ETF dividend portfolio will be paying me at least, or paying the portfolio at least 1,000 here. Therefore, it can compound a little bit faster down the line. But total invested in these ETFs are $8,700. Once again, I'd like to get that up to about $10,000 invested just into ETFs. Looks like I have my $10,000 into Amazon. And that's all that I have for you guys tonight, guys. Thank you guys for being here. Like and subscribe to the channel. It is your boy, the Dividend Dog. I will catch you guys in the next video. I'm out.